Okay, let's unpack this. Welcome to the deep dive. Today, we're really diving headfirst into the very competitive world of Indian FinTech. We're zooming in on four key players. Pine Labs, of course, the listed giant 197 communications. You know them as Paytm. Then there's Zaggle, prepaid ocean services, more B2B focused, and also one Mobikwik systems. Our mission today is pretty straightforward. The Pine Labs IPO is just about closing its subscription period. Listing day is November 14th, 2025. So we really need to figure out what the smart money is thinking. How does this aggressive new player actually stack up both financially and strategically against the ones already listed? We're going to try and quickly distill the key numbers and what analysts are saying, even when they disagree, so you walk away knowing exactly where the battle lines are.
And that timing, it's crucial, isn't it? A big new listing like this, it often forces everyone to rethink existing valuations. What we have here are four really quite different business models, all fighting for investor money and market share. The numbers themselves, they tell a really fascinating story about what the market's actually rewarding right now.
Right. So let's start with the company that's making all the noise, Pine Labs. For anyone not completely immersed in Indian payments, Pine Labs isn't just another app. They are fundamentally a major provider of those point-of-sale systems. The actual machines, the infrastructure backbone merchants use for payments, and increasingly for digital financing options.
That's exactly the context needed. They have these really deep ties with institutions, a very established network. Now, looking at the listing itself, the IPO price band was set between 210 and 221 rupees per share. And our sources are saying, as of today, subscription is, well, hovering just over 50%. It seems retail investors are the main drivers here.
And the structure of the IPO, that suggests pretty big ambitions, doesn't it? We're seeing a large fresh share issue, around 2,080 crore rupees, plus a really big offer for sale, the OFS. That's over 8.23 crore shares. At the top end of that price band, the OFS part alone is worth something like 1,820 crore rupees. Big numbers.
Yeah, and the cash they're raising from the fresh issue, that 2,080 core, it's earmarked for some pretty strategic, maybe even fundamental needs. It's quite telling. They're paying down debt, investing heavily in IT assets, cloud infrastructure, and importantly, buying more of those digital checkout points. So it's a mix, really, shoring up the financials while also pushing hard on expanding their physical footprint.
It sounds sensible, but, putting significant cash towards basic IT and debt reduction, it kind of suggests they might be playing catch-up on some fundamentals, not just pure growth.
Yeah.
Does that worry investors? We
Yeah.
usually try to gauge that pre-listing buzz by looking at the gray market premium, the GMP. What's that showing?
It definitely raises questions, you're right. And the gray market, well, it reflects that caution. The GMP's been trading pretty flat. I mean, it did spike up to 60 rupees recently, but the lowest it hit was actually 0. That sort of flat trading, it signals investors are pretty wary about the valuation they're asking for right out of the gate. The feeling seems to be that the price already bakes in a lot of Pine Labs' future growth, leaving not much room for upside.
And that caution makes sense because Pine Labs isn't entering an empty field. They're stepping into a ring with some serious heavyweights. Once they list, they're immediately up against Paytm, Zaggle, and Mobikwik. So this is where we shift from just the IPO details to the competitive scoreboard. Let's talk scale first. Enterprise value or EV?
Well, the scale of Paytm is still, frankly, astounding. 197 communications. They lead the pack by a huge margin, an EV of almost 70,000 crore rupees. That kind of scale, that inertia, it's real, even after they've had a pretty tough couple of years.
Okay, so if Paytm is the undisputed giant in terms of scale, where does Pine Labs fit in with this aggressive debut?
Pine Labs is aiming for an EV around 18,093 crore rupees. That definitely makes them a significant player, no doubt. But still, less than a third the size of Paytm by that measure. And then you see the smaller, more specialized players. Zaggle is at about 4,349 crore. And one Mobikwik Systems, the smallest of this group we're looking at, is down at 3,380 crore.
Right, so you've got Paytm's massive scale, Pine Labs' aggressive infrastructure play, and then these smaller niche companies underneath. But here's the detail. The one thing that really flips the script on this whole industry comparison, it's the bit analysts are really focusing on.
That's exactly it. Despite being way smaller than these, multi-billion rupee giants, Zaggle Prepaid Ocean Services is the only company out of these four that's actually profitable. The other three, all operating at a loss. In an industry that's been defined by growth at any cost, Zaggle is generating cash. They have a PE ratio of 56.8 times. That kind of disciplined approach, it really stands out. It's an outlier.
That difference, profit versus sheer scale, that's the core tension here, isn't it? Okay, let's dig into the valuation multiples then. These tell us what the market's willing to pay for future potential, even when companies are, well, losing money. Let's start with EV to EBITDA.
Precisely. And for the loss-making companies, these numbers are negative, obviously, because the underlying operations aren't profitable. Pine Labs' EBITDA is sky high, 82.8 times. That reflects the growth premium, the hope we were just talking about. Paytm's is negative 46.4 times. Mobikwik, negative 13.6 times. Zaggle, the profitable one, sits at 38.1 times. Much more grounded.
Okay, and if we switch to EV sales, that's often seen as a more direct measure of just pure optimism about revenue growth, right?
Yeah, it often is. Paytm's actually highest here at 10.1 times sales. Pine Labs is close behind at 8.0 times. And that 8.0x for Pine Labs, that's a key number. If you compare it to Zaggle's 3.3x, well, the market is basically betting 2.5 times more on every future dollar of Pine Labs sales than on Zaggle's, even though Zaggle's the one actually making money right now.
Interesting comparison.
Yeah.
And Mobikwik.
Mobikwik is the lowest at just 1.2 times sales. That usually signals pretty serious market skepticism about, how sustainable or high quality their revenue really is.
Now, speaking of valuations and skepticism, SB Cap Securities valued Pine Labs using an EV-adjusted EBITDA of 50.7x. We just heard the standard EBITDA multiple was way higher, 82.8x. Why the difference? That word adjusted, it's kind of technical jargon, it can be confusing. What are they adjusting out?
That's a really good point to clarify. When analysts use adjusted EBITDA, they're basically giving the company, let's say, the benefit of the doubt. They exclude certain expenses, often things like non-cash costs, like stock-based compensation, maybe one-off restructuring charges, or even just depreciation and amortization. So in short, the adjusted figure presents a perhaps more generous picture of the company's core operating efficiency. It tries to show what the business could earn if it wasn't making these specific, often non-recurring or non-cash investments or charges. It helps justify a lower, maybe more palatable multiple.
Got it. So it paints a slightly rosier picture of underlying performance.
Okay.
Okay, so the financials give us the numbers, the score. But the strategic analysis tells us why the market might be pricing things this way. You mentioned, Harshal Dasani noted, that the market's gotten really cautious about fintech valuations everywhere, not just India. Let's look at the trade-offs he pointed out.
Yeah, Dasani confirms Pine Labs has improved its efficiency. Their FY25 revenue was up 28% year-on-year, over 2,274 crore rupees, and adjusted EBITDA hit 357 crore. That's progress. However, their growth rate is slowing down compared to how fast they were growing before. That's clear.
And that's a potential issue because their valuation is pegged near 2.9 billion US dollars, right? He also flags their heavy reliance on pretty low margin stuff of basic merchant payments, installment financing. That high price tag, it demands, as he put it, strong future execution. There's just no room for error. If that big international expansion plan doesn't deliver big time, that flat GMP we talked about could easily turn negative. There's no safety cushion priced in.
Then you look at Paytm, the scale leader. Dasani argues they're grappling with, fundamental credibility issues and achieving consistent profitability. Their core payments business, it's always been low margin. And while their lending and financial services side is growing fast, over 60%, it faces these twin pressures. There are the regulatory headwinds, which seem to pop up pretty regularly for them, and also just the rising credit risk that comes with expanding lending so quickly.
But wait, if Paytm faces all the constant regulatory battles, profitability challenges, why does the market still give it that high 10.1x EV sales multiple? Is it just the sheer size, the inertia, or is there some hidden value?
It seems to be largely about the reach, the network effect, just the inertia of having millions and millions of users and merchants already plugged into their system. It's hard to displace that quickly. But the investment case, as Dasani describes it, it's fragile. Investors are basically betting on a successful, sustained turnaround. That requires them to stabilize monetization and get regulatory stability. It's definitely a high-risk, potential high-reward situation.
Okay, and what about Zaggle? The profitable one, but in that limited niche.
Zaggle definitely offers the calmest financial picture. Q1 FY26 revenue grew 31% year-on-year. Profit after tax was 26 crore rupees. Solid. But, Dasani correctly points out, there's a question mark over long-term scalability because their business is so tightly focused on B2B expense management and prepaid cards. Profitability is great, yes, but that niche focus probably caps how big they can ultimately get compared to a Pine Labs or a Paytm aiming for broader markets. He summed up the philosophies quite well, I thought. Pine Labs is priced high, hoping for scale payoff. Paytm is this constant turnaround story under intense scrutiny. And Zaggle is disciplined, profitable, but maybe growth constrained.
That sets up Mohit Gulati's perspective nicely. He seems less focused on just the numbers and more on the business culture itself.
Exactly. Gulati emphasizes operational rigor, focus, over just chasing volume. He sort of frames this whole competition as a pecking order based on how structurally sound these businesses are.
Right. This is where we get those really helpful analogies. Gulati argues the market is finally waking up to the idea that discipline in operations is just as vital as having massive distribution reach.
And for him, Zaggle is the prime example of the value of focus. They quietly built this high-margin business serving enterprise clients. They generate cash. They defy that growth at any cost mentality we saw for so long. They basically proved that a specialized, rigorous approach can work without just burning through endless piles of investor cash.
Okay, so Zaggle is focus. Meanwhile, Pine Labs is all about reach, right? Leveraging that huge merchant network, those deep institutional relationships. They're betting they can become the central infrastructure, the backbone for digital transactions.
Precisely. For them, market depth seems more important than immediate profit right now. The bottom line is clearly taking a back seat. And that means, realistically, sustainable profitability is still quite far off. It really depends on how fast and how successfully their international growth plans play out. It's a big bet.
And finally, Gulati's take on Paytm. He calls it the fatigue of scale.
Yeah, it's like trying to steer this enormous complex cruise ship, as you said, while constantly dealing with regulatory storms hitting the deck. They're juggling wallets, commerce, financial services that creates immense complexity to manage effectively. And those frequent regulatory hurdles, they don't just impact the financials directly, they also really sap momentum and, crucially, investor patience.
So pulling these threads together, what's really fascinating here is how this environment forces a choice between very different business philosophies. It's clearly not just about who has the most users anymore. It's becoming about whose model is actually built to last.
Absolutely. The competitive landscape seems to be shifting, rewarding that focus and rigor more. Gulati's three models really capture the core investment decision you face. Do you go for Zaggle's visible, disciplined profitability? Do you back Pine Labs' ambitious, high-priced infrastructure play, accepting the volatility that comes with it? Or do you bet on the ultimate turnaround story, relying on Paytm's massive network inertia, but tolerating all that complexity and regulatory risk?
So the key takeaway then for anyone watching the space really comes down to what Dasani highlighted. Your choice depends entirely on your stomach for volatility versus your need for visible, reliable cash flow. The market really seems to be forcing a showdown between rapid, expensive expansion and disciplined, profitable operations. So to sum up this really dramatic face-off in Indian fintech, the market is basically pitting these highly valued, high-growth, but loss-making giants against smaller, impressively profitable, but maybe strategically limited niche players. The Pine Labs debut is really going to test investor appetite. Do they still prioritize that growth premium above all else, or are they increasingly demanding immediate financial rigor?
And this raises a really important question, something for you to think about. Given how cautious the market seems towards fintech valuations right now, is that infrastructure backbone strategy of Pine Labs, prioritizing reach over profit today, actually sustainable in the long run? How does it compare to Zaggle's high-margin, disciplined B2B focus? Where does that optimal balance between scale and operational rigor truly lie in this industry? Especially, maybe think about which strategy holds up better when the wider economy eventually tightens up.
We certainly hope this deep dive gave you the solid foundation you need to understand the current fintech landscape, especially as Pine Labs makes its high-stakes debut. Thanks for joining us.